opening a trade and finding the right price for an option is an incredibly difficult thing to do. Even after trading full time for the last 3 years, I still haven't gotten this down 100%, but I have developed an easy 4-step process that I'm going to share with you today that's made me about 70% profits since the beginning of this year. The first step that you need to take in order to open any option is going to be to develop an analysis or a thought process on why you think this trade is going to work out. So this can be based on any number of things. It can be based on price levels, it can be based on upcoming news or news that just came out, or this can be based on technical analysis and trends. It's going to be whatever you make it and whatever you feel comfortable with. So for me, I am a huge fan of using price levels, and I have become really good at predicting events. So those are the two things that I stick with, events and price levels. So I develop an analysis around these events using these price levels, and I try to determine how is this news going to affect the stock. So you need to take whatever analysis that you have and apply it to what could happen to the stock market because of your analysis. So your analysis is going to lead you into developing a sentiment for the stock market, or which way you think the stock market is going to go. So there are 3 main sentiments for the stock market. You have bullish, you have bearish, and then you have neutral. So I'm going to give you a strategy for each of these. So for a bullish trade, if you're assuming that the stock market is going to go up from where it's trading right now, then you could either use a call debit spread or you could buy a plain long call option. And this will allow you to make money if the stock goes above the strike price that you chose and above your break-even price if you're buying a long call. But if you're bearish on the stock and you think that your analysis is going to make the stock market come down, then you could either use a put debit spread or you could buy a long put option. So with a debit spread, a put debit spread, you're assuming that the stock is going to be below your strike prices. So you want to set the price levels to where you assume the stock is going to be below. And with a long put option, you want the stock to be below your break-even price on your expiration date. So those are the 2 bearish strategies. And finally, you have the neutral strategies. So whenever you're neutral on a stock, you're assuming that it's going to trade flat. And there's a couple ways that you could play this. You could either do an iron condor, where you're basically creating a call credit spread and a put credit spread, and you're assuming that the stock is going to be between the strike prices that you choose for your calls and your puts. So for example, if I think that SPY is going to stay between $400 and $420 next week, what I would do is I would sell a $420 call, buy a $421 call, and then I'm assuming that it's going to stay above 400, so I'm going to sell a 400 put and I'm going to buy a $399 put. So this is a neutral strategy since SPY is trading between these 2 strike prices right now. And you could also use another strategy if you have a lot more money, which is known as a short strangle. Now, with a short strangle, you're going to need enough money to buy 100 shares of the stock, and you're going to need 100 shares of the stock itself. So basically, you're going to need enough capital in order to own 200 shares of the stock. So this can get really expensive, especially if you're trading something like SPY. This would cost you around $80,000. But these are the 2 neutral strategies for you. And then you can also be bullish to neutral. So you can assume that the stock is either going to trade flat or go up. And the best way to trade that would be a put credit spread or selling a cash secured put. Or you could be bearish to neutral, so you're assuming that the stock will either trade flat or come down. And with this, you could either do a cover call or you could do a call credit spread. So those are all the strategies for different sentiments. And now that you have the sentiments, you have to choose what strike prices you think the stock is going to be above, below, or between. Now, I've found that price levels are the best technical analysis tool. A lot of traders will overcomplicate their trading by having RSI, MACD, and 100 different other indicators on their screen where it looks pretty messy, but I like to keep things clean. I like to keep things simple because the stock market is just based on people buying stocks and people selling stocks. And They're specifically looking at different prices to buy and sell at. So all I look at whenever it comes to technical analysis is price levels. Call me a basic bitch. This is what's worked for me though. So the way that I use price levels is I first develop my sentiment. So we've come full circle. And then whatever sentiment that I have, I'm going to base the strike prices that I choose on the price levels that I have set. So for example, today I ended up buying a 407, 408 call debit spread after I heard what Fed Chair Powell came out and said at 1:30 p.m. So I was extremely bullish for the stock after hearing what he had said, and SPY was trading at around $403 at the time. So I set up some price levels on the daily chart, and I figured that it would fill a gap that it had created just a couple months ago. Now, whether it was just luck or if it was me guessing correctly, we'll never know.
Everybody want to know what I would do if I didn't win. I guess we'll never know.
SPY ended up closing the day at $407.80. So I was very close in choosing my strike prices, and this option expires tomorrow. So if SPY is above my $408 strike price at $3.59 tomorrow on expiration, then I'm going to be taking my max profit for that trade. So I use that 408 price level to set my strike prices for this call debit spread, where I bought the $407 call, and then I sold the 408 call, where I assume SPY would be above in order to fill in that gap from the daily chart. But whenever I opened this trade, I didn't have a lot of confidence in it. And this brings me to the last part of opening a trade, which is all about risk tolerance. So the way that I've been using risk tolerance, if I'm less confident in a trade, like this call debit spread that I had opened, then I'm not going to put as much money down for that specific trade. So for my less confident trades, I'm not going to risk more than about 5% of my total options capital. So I have $10,000 in my options portfolio. I have $70,000 total. So of my $10,000 that I've set aside for options trading, I'm only risking about 5% for a low confidence trade. But if I'm highly confident in a trade, then I'm going to base my risk tolerance based on how much money I want to make or how much money I think that trade is worth. So a good example of this is a trade that I made for TLT after Fed Chair Powell came out and talked about inflation. So I was bullish on bonds because I knew that rates would start to drop after he said that we're likely going to do 50 basis points in December. So I ended up opening a put credit spread, assuming that TLT would stay above where it was today. So my expiration date is set for this Friday, and I'm assuming that TLT is going to stay above $102. And I figured that this trade was worth around $600 to $700. So I set my risk accordingly. Now for this trade, I'm risking about $1,800. So that's about 18 to 20% of my options portfolio that I'm putting up on this high confidence trade. But I'm not going to take that $1,800 loss. I have those price levels in mind to where I'm going to exit before I reach my max loss. So I'm not going to take on that full 18% drop for my options portfolio. So using a combination of these price levels, your sentiment for the stock, and finally setting a confidence level for this trade in order to allocate your risk is the best way in order to open an option. But you don't want to be unrealistic whenever it comes to how much money you want to make on a trade. Like, I could have told myself this trade is worth $5,000 and I could have risked, $15,000, but it really wasn't worth that much money to me. So you have to be realistic with yourself if you're opening your trades based on how much money you want to make or how much you think the trade is worth. And the last step in opening an options trade is just opening the damn trade, because I know a lot of people just get analysis paralysis and they're not willing to open a trade because they're too scared. but you are going to miss 100% of the shots that you don't take. This is something that I've learned in my years of being a trader, is to take on a lot of quality positions, but you shouldn't be using this as an excuse to overtrade and open as many trades as you can, because there is such thing as overtrading. If you're doing quantity over quality, then you're going to get jumbled up. You're not going to know which trades that you have open right now, and your mind is just going to be foggy, and you're probably going to end up losing money if you're focusing on quantity of trades versus quality of trades. And this really comes back to having a solid analysis. So now we've come full circle. Hopefully this video was useful. Thanks for making it all the way to the end of this video. And thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys. Call me a basic bitch. Call me Stacy. Call me whatever you want.